A founder sits across from a venture capitalist, sliding a term sheet across the table. The investor wants 20% of the company. To the founder, giving up a fifth of their life's work feels like an aggressive, painful extraction. But to the investor, sitting on the other side of the table, 20% is the baseline requirement for the math to function. This disconnect exists because founders and investors operate under different mathematical realities. A founder bets their career on a single entity succeeding. A venture capitalist builds a portfolio knowing that the majority of those companies will fail or barely break even. The venture capital model relies on the power law. Because failure is the statistical default for most startups, a tiny fraction of the portfolio must grow large enough to offset every other loss in the fund. VC firms target 20% ownership as a structural safeguard. In an asset class where most investments go to zero, capturing a significant portion of the rare winners is the only way to cover the fund's total losses and remain in business. Industry-standard ownership targets are well established, though they shift depending on the maturity of the company and the size of the check. This chart maps those shifting expectations. At the earliest stages, pre-seed and seed investors typically target between 10 and 20% ownership. They are writing smaller checks, but they are absorbing the maximum amount of risk before the company has proven its market fit. At Series A, the dynamics change. These investors write significantly larger checks, often between $5 and $15 million. They take board seats, provide operational support, and demand 15 to 25% of the company to justify that concentrated capital outlay. Early-stage investors know their ownership will eventually shrink as subsequent funding rounds issue new shares. They have to secure a large enough slice at the start to protect the final value of their stake when the company eventually exits. These stage-specific targets act as the foundation for the entire venture model. As the fund math will soon demonstrate, failing to secure this base ownership early on makes even a billion-dollar exit mathematically irrelevant to the firm's survival. To see why that is, we have to look at the economics of the venture firm itself. VCs are essentially middlemen. They manage capital provided by external limited partners, like university endowments and pension funds. To justify the high risk of venture capital, LPs expect a massive return. The industry standard requires a VC to return at least 3 times the total size of their fund. If a venture firm raises a $150 million fund, they are contractually obligated to return $450 million to their investors before they can consider the fund a success. This creates a mathematical bottleneck. Out of the 12 to 15 investments made from that fund, only 6 to 8 might offer any positive return. This means just 1 or 2 outlier winners must generate over $100 million in profit each to hit the overall fund target. Here is where low ownership breaks the model. If a startup in that portfolio successfully exits for $500 million, but the VC only holds a 5% stake, that yields $25 million. While a victory for the founders, it falls $75 million short of what the VC needs from a winner. Contrast that with the 20% mandate. That same $500 million exit now yields exactly the $100 million required to keep the fund on track. The absolute size of the venture fund dictates the required size of the outcome. For a fund of any substantial size, substantial ownership is the only viable strategy to meet LP obligations. Because these requirements are rigid, VCs do not guess at a startup's current valuation. They engineer the deal backward from the finish line. They rely on a formal financial framework known as the venture capital method to reverse engineer startup valuations. The process begins by estimating the terminal value of the company at a planned exit date, usually 4 to 7 years in the future. Once they project that future value, the VC applies their target rate of return, solving backward to find the exact present-day ownership percentage required to justify the investment. The 20% demand on a term sheet is the final output of an equation that begins years in the future. Understanding these constraints provides founders with leverage at the negotiation table. You are no longer arguing over perceived value, you are negotiating against their fund math. A founder can compress the required equity percentage by generating competitive interest from multiple firms. High growth rates and proven revenue milestones allow the founder to dictate a higher valuation, which lowers the percentage an investor can claim for the same check size. However, you must be aware that there is a specific, dangerous signaling risk when dealing with massive, multi-stage funds at the seed level. If a billion-dollar multi-stage fund takes a smaller 14% seed stake and later declines to increase their ownership to a core 20% position at Series A, the broader market perceives the company as a failure. Other firms assume the inside investor saw a flaw in the data and decided not to lean in. Accepting money from a large fund without a commitment to a 20% position creates toxic signaling that makes it difficult to raise future rounds. Venture capital fundraising is always a high-stakes trade. Founders need to understand the underlying math of their investors to know exactly what they are giving up and why. You should never walk into a pitch without knowing your numbers and the specific mathematical outcome you are trading for capital. The 497 VC funding blueprint kit includes Canva pitch themes, an AI financial narrative engine, a psychology guide, custom AI prompts, and a complete sales deck. Subscribe for more startup breakdowns. That 20% stake is an investor's calculated path to a return that justifies the existence of their entire fund.